A double top in a market is formed when after a price move there is a top formed and then there is a down move and then the next top that is formed that is at the same level of the previous top, like this and then the price start falling. Now according to a Dow theory, a up move is a sequence of higher highs and higher lows. Now as soon as we find a similar low, then there is a possibility that the uptrend that was already there is towards the end. Now, the moment the low is violated, like if we see it forms in the shape of an M here, then comes back and then. Now, when this line that is connecting the lowest point or the intermediate low and a horizontal line that is breached, then if the price start falling, then we say that this is a double top. Similarly, in the case of a down move, if after a down move there is a pullback and the next low is at the same level of the previous low and the horizontal line that is drawn with the help of the intermediate high is actually breach on the upside, then we can say that market has formed a double bottom. Now, both in the case of double top and double bottom, the target of the move is actually high of these two similar highs and the distance between the high and the horizontal line, and in the case of double bottom, the lows and the horizontal line. And once there is a breakdown for the case of double top from the horizontal line, the target is that distance that is earlier measured, and in the case of double bottom also, once the breakout is there, the target is the distance that is between the neckline and the bottom. Now, where should be the stop loss? Classical literature asks you to have a stop loss that is at the, in the case of double top, that is just above the top of the pattern, and in the case of double bottom, just below the bottom of the pattern. But in that case, you are ideally having a 1:1 risk reward ratio. There is a better way to do that. Let us understand first from the double top. Normally what happens is that once the double top is formed, price breaches the neckline and then there is a pullback to the neckline and then falls again. So this is a secondary selling opportunity. Similarly, in the case of double bottom, once the price breaches the neckline, normally, not always, there is a pullback to the neckline and then the price rises again. This is the secondary buying opportunity. So ideally, one should not go all the positions or take all the positions on a single go. One should wait for the pullback. So positions has to be taken in two go. The first when the breach is there, and then if there is a pullback, then a part of position can be taken then also. And the stop loss should be little bit above the neckline. What happens what happens is that in the pullback, if it is quite fierce, it normally breaches the neckline, and then after all the people have cut their stop loss, it goes down. And in the case of double bottom, after everyone has bought and the neckline is breached a little bit deeply, the price then resumes up move. So rather than having stop loss just at the necklines or at the top, at the bottom, a little bit above the neckline in the case of a double top, and in the case of a double bottom, a little bit below the neckline. So once a double top is breached, someone should sell with a stop loss, and in the case of double bottom, someone should buy with a stop loss which is a little bit away from the neckline. Now let us look at the examples here. Here we are looking at the Raymond daily chart, And in the Raymond daily chart, what we could see that this beautiful double top was formed, and see when the pattern actually broke down, we saw quite a bit of higher volume than the consolidation level. So we could understand that if at the breach of the double top there is a higher volume, then we can be assured that the down move that is unfolding can be sustainable. And see, from 1050 it went to 825 in a small bit of time, much higher than the ideal 1:1 target of the double top. Similarly, if we can look at the ONGC chart here again in the daily chart, a double bottom was formed, and once it is breached, we saw the volume picking up, and once the breach is there, again there was a slight pullback that took prices just again below the neckline, and then once the price moved out of the neckline, we could see a fierce rally, right? One important point that we need to keep in mind in the case of a double bottom is that in the double bottom, if the uppish legs, like here in the case of ONGC, this leg and this is the next leg, if those uppish legs are having quite a bit of higher volume compared to the down legs, then there is a possibility of success of this double bottom is much higher. Similarly, in the case of double top, if the volume in the down move is quite higher compared to the volumes in the up move, we can understand that the possibility of the success of the double top is little bit higher. So this is all about double tops and double bottom. Always when you see a pattern, try to look at the periodicity, how much time it has taken. Look at the pattern height, the pattern during the number of days taken to build the pattern, because if the number of days to build the pattern is higher, or if the pattern is big, then the implication of the break of the pattern is quite higher. So always keep that in mind. So this is all about double top and double bottom. We will discuss triple top and triple bottom in our next video. Thank you.